Have you ever wondered what connects world-changing companies like Google, Amazon, and Facebook? What secret ingredient propelled them from humble startups to global giants? Today on my podcast, The Beginner's Mind, I uncover that mystery. I'm Christian Soschner, and in this episode, we are diving into The Power Law by Sebastian Mallaby, a book that reveals the hidden force behind the most explosive successes in modern business, venture capital. The Power Law isn't just a story about capital. It's a tale of vision, daring, and the transformative power of bold ideas backed by the right investment. The Power Law takes the reader on a journey through the high-stakes world of venture capital, where a single decision can ignite a revolution or spell disaster. Why did I pick this book from my reading list? The book offers a rare window into the engine room of innovation, explaining how venture capitalists have shaped our world in ways we often don't realize. Whether you're an entrepreneur, an investor, or simply intrigued by the forces that drive modern economics, this book here is a thrilling ride through the highs and lows of venture capital. So join me on a journey through the book in which we explore the fascinating stories, key insights, and the powerful lessons the Power Law has to offer. It's not just a book review, it's a glimpse into the future of innovation and enterprise. Let's get started. Before we delve into the intricacies of the Power Law, let's take a moment to understand the mind behind this masterpiece. Who is the author Sebastian Mallaby, and what makes him the perfect narrator for this story of venture capital and innovation? Sebastian Mallaby isn't just any author. He's a renowned journalist and commentator on the world of finance and economics. His resume speaks volumes. A contributor to the Financial Times, a columnist for the Washington Post, and a senior fellow at the Council on Foreign Relations. But what truly sets Mallaby apart is his unique ability to weave complex economic and financial concepts into compelling narratives. His previous works, like More Money Than Gold, Hedge Funds, and The Making of a New Elite, and The World's Banker, a story of failed states, financial crisis, and the wealth and poverty of nations, have been widely acclaimed for their insightful and accessible analysis of the financial world. But why does this make him the ideal author to tackle the enigmatic world of venture capital? It's his deep understanding of global finance, combined with his knack for storytelling, that allows Mallaby to bring the secretive world of venture capital to life. He doesn't just present facts and figures, he delves into the personalities, the conflicts, and the high-stakes gambles that define venture capital. In The Power Law, Mallaby leverages this expertise to offer the reader a front-row seat to the decisions and dynamics that drive the venture capital industry. His comprehensive research and engaging writing style illuminate the successes and failures, the visionaries and the risk takers, and the sheer force of will that fuels this fascinating world. Do you want to listen to what Sebastian Mallaby has to say about the book? Then listen to the author interview on my podcast in episode 92. So now, as we turn the pages to the first chapters of The Power Law, remember that we are not just reading a book. We are embarking on a journey guided by one of the most astute observers of our financial era. So with that context about Sebastian Mallaby, let's dive into the heart of The Power Law and discover the untold stories of venture capital that have shaped our present and are molding our future. As we delve into the power law, it's important to grasp the real essence of venture capital as Sebastian Mallaby paints it. This isn't just about big money and big names. It's about a high-stake game of risk and reward where the future of technology and our society often hangs in the balance. Mallaby invites the reader to see venture capital as a realm of true adventure. It's not about the safe bets, it's about leaping into the unknown, backing ideas that are too bold, too raw for traditional funding. This is where Mallaby's narrative shines, revealing a world where messy information leads to binary, make or break decisions and nothing in between, where the norm is to be frequently wrong, yet resiliently optimistic about the future. Now, some might see this world as one driven by greed or a lack of skepticism, as pointed out in the New York Times article about the book Sebastian Mallaby wrote. But Mallaby digs deeper. He shows the reader that venture capital is more than just a hunt for the next big payday. It's a pursuit of innovation, of breakthroughs like synthetic insulin or plant-based meats, ideas that once seemed far-fetched, but now shape our everyday lives. However, Mallaby doesn't shy away from the industry's complexities and contradictions. He acknowledges that venture capital can sometimes create distorted playing fields or back founders who later stumble. But he also argues that these are outweighed by the industry's ability to fund disruption and drive progress. In The Power Law, Sebastian Mallaby takes the reader from the origins of venture capital with the traitorous eight and Fairchild Semiconductor to the present day's tech behemoths. Mallaby gives a vivid picture of the venture capitalists, mentors, coaches, and those betting on unorthodox genius. It's a diverse portrait showcasing varied philosophies and approaches to funding innovation. But it's not all rosy. The book reveals a venture capital world grappling with its own shortcomings. A world too white, too male, and too elite. Mallaby's call for diversity and inclusivity in this field is a crucial point, highlighting a need for change in an industry that changes and shapes our future. In the next segment, we will look at the key takeaways from the Power Law and how Mallaby's insights can inform our understanding of venture capital and its role in crafting tomorrow's world. So stay tuned and bear with me. With the book The Power Law, Sebastian Mallaby doesn't just tell a story. He shares a treasure trove of insights, lessons, and maxims that illuminate the art of venture capital and disruption. First, let's dive into some of the most striking takeaways from the book. These insights are not just theoretical, they are blueprints for understanding and navigating the world of innovation and investment. So if you don't have much time today, just listen to this segment for a quick snapshot and overview of my key lessons from this book. The first lesson is about embracing risk as a pathway to reward. Venture capital is fundamentally about embracing risk. Mallaby's narrative shows that the biggest breakthroughs often come from the boldest bets. Whether you are an entrepreneur or an investor, understanding and accepting the inherent risks can lead to unprecedented rewards. Perhaps one of the most sobering yet inspiring lessons is the dual nature of risk and reward. As Mallaby puts it, the most you can lose is 1x on your money, one time your capital. But the most you can win or miss out on absolutely has no limit. This encourages a fearless approach to risk, a fundamental attitude for anyone looking to make a significant impact. The second key lesson is the power of visionary thinking. The success stories highlighted in the book underline the importance of visionary thinking. Entrepreneurs who can see beyond the present, imagining what could be rather than what is now, often attract venture capital. For anyone looking to make their mark, cultivating a visionary mindset like Elon Musk has, like Jeff Bezos has, like Steve Jobs had, is key to success. Mallaby highlights that the most groundbreaking advancements often come from those outside traditional fields of expertise. Figures like Musk, Bezos, and Zuckerberg didn't just follow the trends. They envisioned and built new paths, reminding us that radical rethinking is often the precursor to true innovation. The third key takeaway is the significance of the power law in success. Mallaby elucidates the power law, the idea that a small number of investments yield the most significant returns. This concept isn't just applicable to venture capital. It's a principle that can be observed in various aspects of business and personal growth. And some listeners might probably know this law under the name the Pareto principle. Identifying and focusing on the areas with the highest potential impact can optimize outcomes in any endeavor. The fourth key takeaway is the role of venture capitalists. Venture capitalists are more than just financiers. They are mentors, strategists, and partners. Mallaby's accounts reveal that the most successful VC entrepreneur relationships are those where there is mutual respect, shared vision, and active collaboration. This insight is invaluable for anyone looking to forge productive partnerships in business. The fifth key takeaway is the impact of venture capital on society. Mallaby challenges the reader to consider the broader impact of venture capital, not just on technology and economy, but on society at large. From fostering innovation that addresses global challenges like climate change to reshaping entire industries, the role of venture capital is profound and pervasive. In the sixth key takeaway, I discuss the value of networks. Metcalfe's law and the importance of network effects demonstrate how the value of a network grows exponentially with each new participant. This principle, vital in the tech industry, also applies to personal and professional networks. And finally, the last key takeaway, embracing the unknown. Not fear it, embrace it. Vinod Khosला's investment test simplifies the venture capitalist's dilemma. Can you identify why a venture might fail, assess the founder's capabilities, and foresee significant returns? This mindset is essential, not just in venture capital, but in all forms of entrepreneurship and innovation. Often VCs invest in entrepreneurs operating in totally new territory where absolutely no market exists yet. These 7 key insights from the Power Law offer a glimpse into the mindset and mechanics behind venture capital's ability to disrupt and drive progress. Mallaby's book is not just a collection of stories, it's a manual for those daring to dream big and bold. For those who find these lessons intriguing, I highly encourage diving into the full narrative of the Power Law to uncover the depth of knowledge Sebastian Mallaby shares. And for the listeners who are on this journey with me, stay tuned as we explore more about the ventures and visionaries that have shaped our digital landscape. In the introduction chapter of the Power Law, Sebastian Mallaby lays the foundation of a concept that's as captivating as it's crucial to understanding the venture capital world. It's here that the reader is introduced to the principle that not only defines, but also dictates the pace and direction of innovation and investment. This principle, the Power Law, itself. Imagine a world where the improbable isn't just possible, but is precisely what's most valued. This is the world Vinod Khosla, a titan of venture capital, inhabits. His mantra: the only thing that's important is something that's improbable. It's this appetite for the audacious, for ideas so bold they might just render the entire meat industry redundant, that exemplifies the power law in action. Kostler's investment philosophy is not about seeking safe, incremental changes. It's about backing radical dreams with the potential to transform our society. But what exactly is the power law? It's a concept revealing that a small number of investments generates the vast majority of profits, a principle where winners advance at an exponential rate, leaving linear progression in the dust. This isn't just a theory, it's the reality of venture capital. Peter Thiel, another luminary of the investment world, puts it succinctly. The biggest secret in venture capital is that the best investment in a successful fund equals or outperforms the entire rest of the fund. The power law is the essence of venture capital, a high risk, high reward domain where the power law reigns supreme. This skewed distribution of outcomes, where a handful of investments cannot shine and will outshine the rest, isn't confined to financial portfolios. It's a phenomenon observed and mirrored in the wealth of nations, the citations of scientific papers, blockbuster music, retail investor portfolios, and yes, also the success of startups. This introduction chapter doesn't just explain, it enthralls, drawing the reader into stories of investments like Kostler's backing of impossible meat, illustrating the high-stakes game of venture capital. It's a game where the risks are monumental, but the rewards even more so. Vinod Khosla, a venture capitalist who embodies the power law, doesn't look for the safe bets. He seeks out the radical, the dreams so daring they could render entire industries obsolete. To Khosla, the question isn't whether an idea is likely to succeed, but whether its success could be transformative. This mindset where the most you can lose is 1 times your money, but the most you can win has no limit, isn't just about finance. It's about daring to reshape the human reality and future. And as the reader traverses through these tales of audacity and innovation, Mallaby poses a compelling question. Which is better, to try and fail or to fail to try? It's a question that resonates beyond the realms of venture capital, touching the very essence of human endeavor. So, as we delve deeper into the heart of the power law, remember, we are embarking on a journey through a world where the improbable is the goal, and the impossible is just another challenge waiting to be overcome. Stay with me, as there is much more to uncover about how venture capital shapes not just the markets, but the very fabric of our future. Chapter 1 of the Power Law transports the reader back to a defining moment in the annals of innovation and finance. It's the late 1950s, a period not just marked by the Cold War and rock and roll, but also by the birth of financial revolution, venture capital, or as it was originally termed, adventure capital. This new form of finance wasn't just about money. It was about liberation. It was a tool that enabled talent to break free from the constraints of traditional corporate structures, embarking on ventures that were as risky as they were revolutionary. Arthur Rock, a name synonymous with the genesis of venture capital, played a pivotal role in what was known as the defection of 1957. This wasn't merely a financial transaction. It was the catalyst for a revolution that would eventually birth Silicon Valley as we know it. The Fairchild Semiconductor story is at the heart of this chapter, a narrative that demonstrates how liberation capital could transform a group of talented individuals into industry pioneers. Fairchild wasn't just another company. By 2014, an astonishing 70% of the publicly traded tech companies in Silicon Valley could trace their lineage back to it. This staggering statistics underscores the monumental impact of Fairchild, not just as a technological innovator, but as the progenitor of a commercial culture that values bold, transformative ideas over incremental advancements. But where did this unique culture of innovation and entrepreneurship come from? Mallaby explores various theories, from the gold rush's legacy of individualistic hustle to the progressive ethos fostered by California's prosperity and educational system. Yet, it's the introduction of venture capital, or liberation capital, as Mallaby aptly renames it, that emerges as a critical driver of this culture. This new form of finance didn't just unlock human talent, it reshaped the very fabric of applied science and commercial enterprise. The term venture capital itself, a derivation from adventure capital, reflects the essence of this financial revolution. It's about embarking on ventures where the greatest rewards lie in the most ambitious and least obvious projects. It's a realm where investors like those early pioneers at Fairchild engage not just with their capital, but with their time, expertise, and passion, helping to build companies that would redefine the technological landscape. As we close now the chapter on Afarock and the liberation capital that fueled the formation of Fairchild Semiconductor, the reader is reminded of the transformative power of venture capital. It's a story of how daring to invest in the improbable can unlock potential, forge new industries, and indeed change the world. Stay with me for chapter 2 as we continue to explore the narratives and lessons of the power law, uncovering the ventures and visionaries that have shaped the digital revolution. Venture capital often conjures images of cutting-edge technologies and groundbreaking products. Yet, as we turn now to chapter 2 of the power law titled Finance Without Finance, we are invited to see beyond the tech. Here, Sebastian Mallaby presents a compelling argument, one that Arthur Rock and his contemporaries instinctively understood. The essence of venture capital isn't just about investing in technology, it's about investing in the people who create that technology. Peter Drucker, a visionary in his own right, observed that established businesses tend to invest in familiar fields. However, the pioneers of venture capital, such as Davis and Rock, veered away from conventional wisdom, ignoring the modern portfolio theory, which advocated for diversification to mitigate risk. They chose a different path. They made concentrated bets on a selected few companies, a decision that wasn't about finance in the traditional sense, but about faith in people. The central principle of the venture business, Davis once boldly stated, can be summed up in 4 words: back the right people. This philosophy, echoed by Rock in his advice that the single most important factor for any company, especially in the applied science industry, is its management. It's a sentiment that underscores a fundamental truth about venture capital. The tech is vital, but the people behind it are paramount. Avoid's role in catalyzing the creation of Fairchild Semiconductor further illustrates this principle. It wasn't merely Rock's financial investment that made Fairchild a cornerstone of Silicon Valley's tech industry. It was his ability to see the potential in the founders, to open their eyes to the possibilities of owning the fruits of their labor, and to foster an equity culture that would define the valley for decades to come. Chapter 2 challenges the reader to rethink the narrative of venture capital. It's a reminder that at the heart of every technological breakthrough, at the core of every innovation, are the visionaries, the dreamers, and the doers. Venture capital, in its most transformative form, is about recognizing and empowering these individuals. It's about financing the future, but doing so through the talents and aspiration of those who dare to reimagine it. Chapter 3 of The Power Law unfolds a narrative that showcases the transformative impact of venture capital through two emblematic stories: Genentech's biotechnological breakthroughs and Atari's pioneering venture into the world of video games. This chapter, titled Sequoia, Kleiner Perkins, and Activist Capital, takes the reader deep into the essence of what venture capital truly means: investing in visionary people who dream of technological frontiers. In the summer of 1972, Atari introduced the world to Pong, a simple yet captivating video game that marked the dawn of an era. Unlike previous ventures backed by Arthur Rock, where the gameplay lay in technology's viability, Atari's challenge was in its business, marketing, and the unpredictability of its wild man risk. Yet, it wasn't just about the game, it was about proving that even the most trivial technology, when backed by the right people, could revolutionize entertainment and inspire future visionaries like Elon Musk. Simultaneously, a seismic shift was happening in biotechnology. A conversation between venture capitalist Bob Swanson and scientist Herbert Boyer sparked the creation of Genentech. Swanson's proposition was that instead of filing for grants, going for venture capital. Swanson's proposition: what if you had all the money right from the start? It shifted Boyer's perspective, illustrating how venture capital could expedite the commercialization of recombinant DNA technology. Genentech wasn't just a company, it was a venture that exemplified the new breed of activist capital, where venture capitalists didn't just fund, but actively shaped their investments. This chapter 3 reveals that venture capital thrives on backing the right people, those capable of turning nascent technologies into industries. From the arcade bars of the Bay Area to the laboratories pioneering biotech, the message is clear. The true essence of venture capital lies in its belief in human potential. Both Atari and Genentech stories underline a critical evolution in venture capital. The era of hands-on activism and stage-by-stage financing emerged, defining a new approach where venture capitalists became deeply involved in guiding, shaping, and sometimes even incubating the companies they believed in. As we reflect on the tales of Atari and Genentech, we are reminded of the profound impact that visionary individuals, supported by equally visionary investors, can have on our world. These stories aren't just about the birth of industries, they are about the dreams that venture capital can help realize, proving that with the right support, even the most improbable visions can come to life. The key lesson from chapter 3: venture capital is about much more than finance. It's about faith in people, faith in their dreams, about investing in those who dare to reimagine the future, whether through the pixels of a video game or the genes of biotechnology. Chapter 4 of The Power Law whispers the story of Apple, a saga that intertwines the destinies of visionaries Steve Jobs and Steve Wozniak with the nascent venture capital world. This isn't just a tale of technological innovation, it's a profound exploration of venture capital's pivotal role in shaping what would become one of the most influential companies in history. In 1976, amidst a burgeoning field of potential, Apple was born not merely as a company, but as a testament to the revolutionary potential of activist capital. Despite the clear vision of Jobs and Wozniak, the venture capital luminaries of the time hesitated. I mean, the initial vision of Apple was selling 1 million personal computers, which is not very grand. And this also describes the innovator's dilemma as articulated by Clayton Christensen. It played out at Apple in real time, with companies too entrenched in the status quo to see the PC's disruptive potential. Nobody wanted to back Apple. It was a world ripe for venture capital. Yet initial reactions were tepid, underscoring that even the brightest minds in venture capital could miss the forest for the trees. Jobs and Wozniak faced rejection after rejection. Their revolutionary ideas often met with skepticism or outright disbelief. The narrative could have ended there, were it not for the serendipitous intervention of Don Valentine of Sequoia. Valentine's eventual backing of Apple, despite his initial reservations, marked a turning point not only for Apple, but for the venture capital industry itself. His insistence on bringing in Mike Markula, helping the two Steves working on their business plan, creating a bigger vision for the company, and Markula also being arguably the Valley's first angel investor, it was simply a masterstroke. Blending financial support with invaluable business, sales, and technological acumen. This chapter again also whispers of Atari, the company that started it all for computer games, laying the groundwork for dreamers like Elon Musk. Atari's story, paralleled with Apple's, underscores the diversity of venture capital's impact. From the previous chapter, Genentech, biotech, to gaming with Atari, to computer industry with Apple, illustrating the breadth of innovation it fuels. The financing of Apple, fraught with near misses and what ifs, showcases the venture network's strength and the unforeseeable impact of serendipitous connections. It wasn't just about the money, but about the momentum and credibility that venture backing provided. By the time Apple went public in December 1980, it was clear. The venture capital industry had not only funded the company, but had helped launch a revolution that redefined the technological landscape. As we now at the end of this chapter reflect on Apple's journey from a garage in Los Altos to a global powerhouse, let's remember the vital lesson Chapter 4 imparts. Venture capital is about seeing beyond the immediate, about believing in the transformative power of people and their ideas. Apple's story is a testament to the venture capital spirit, a whisper of what's possible when mission meets opportunity provided by venture capital. Chapter 5, Cisco, Freecom, and the Valley Ascendant, delves into the heart of Silicon Valley success, a narrative enriched not just by groundbreaking technologies, but by the very spirit of collaboration and open exchange of ideas. This chapter isn't merely a chronicle of technological advances, it's a testament to the sociology of innovation that powered Silicon Valley's rise. Silicon Valley, as portrayed by Berkeley sociologist Annalise Xenian, stood in stark contrast to its counterparts in Boston and Japan. While elsewhere, secrecy and vertical integration were the norms, the valley thrived on the movement of ideas and people. This ecosystem, a bubbling cauldron of small firms, was vigorous not despite but because of its collaborative culture. Here, the barriers between companies were porous, allowing for a dynamic exchange that fueled innovation at an unprecedented pace. This chapter also highlights the essence of the Kume formula, a strategy of bringing in external management to bolster a startup's strength. It exemplifies the Valley's approach to building companies, an approach where collaboration and the right partnerships were as crucial as the technology itself. Let's remember that. It's about the people, big vision, in a spirit of collaboration and open exchange of ideas, and the right partnership. And then the last point is the technology itself. The story of Freecom and its founder, Bob Metcalfe, serves as a perfect illustration. Metcalfe's insight that the utility of a personal computer would skyrocket once networked, later known as Metcalfe's law, underscores the exponential power of connections, both technological and human. Venture capitalists in Silicon Valley were not just financiers, they were connectors, fostering collaborations that would solve engineering challenges and propel companies like Freecom to success. Sequoia Capital's investment in Freecom and its role in brokering a partnership with chipmaker SEC is a case in point. These weren't just business transactions. They were the creation of an intricate web of relationships that propelled the entire industry forward. As Cisco, Freecom, and the Valley Ascendant unfolds, the reader is reminded that Silicon Valley's ascendancy was built not only on the brilliance of its technologists, but on a culture of open collaboration and mutual support. It's a powerful reminder that the most transformative innovations often arise from a community willing to share, challenge, and build upon each other's ideas. Let this chapter serve as an inspiration, not just for those in technology or venture capital, but for all of us. The spirit of collaboration, of reaching across boundaries to share insights and ideas, is something that can propel not just industries, but society itself toward a brighter, more connected, and prospering future. Chapter 6, titled Planners and Improvisers, introduces the story of Accel, a venture capital firm that distinguished itself with a methodical approach in the dynamic landscape of Silicon Valley. Accel represented a paradigm shift, embodying the essence of strategic planning and a deep belief in the power of preparedness. While the swashbuckling spirit of Kleiner Perkins captured the Valley's imagination, Accel, led by Arthur Patterson and Jim Swartz, carved out its niche with an eye towards meticulous strategy and long-term vision. Patterson, a Harvard-educated thinker, brought a broad perspective to the venture capital world, focusing not only on emerging technologies, but also on the nuances of financial markets, business models, and even government policy. His mantra, borrowed from Louis Pasteur, chance favors only the prepared mind, became Accel's guiding principle. Jim Swartz, with his roots in small-town Pennsylvania, complemented Patterson's approach with a steadfast belief in character and discipline. Together, they crafted Accel's identity as a firm that prioritized specialization, particularly in telecoms, foreseeing the exponential growth of an information-based economy. This foresight allowed Accel to make strategic bets, often backing successive iterations in a single product class, leading to significant returns on their investments. Accel's journey wasn't just about picking the right companies. It was about understanding the broader trends that would shape the future of technology. The firm's focus on telecoms was prescient, anticipating the explosion of internet traffic driven by Metcalfe's and Moore's laws. This wasn't venture capital by intuition, it was venture capital by intellectual rigor. The story of Axel in Chapter 6 is a compelling narrative that underscores a critical lesson. Success in venture capital, and indeed in any endeavor, often requires more than just being in the right place at the right time. It demands a prepared mind, one that is ready to seize opportunities not just through serendipity, but through strategic planning and unwavering commitment to understanding the forces that drive markets. As we reflect on Axel's approach, let's remember the value of planning, the importance of deep industry knowledge, and the power of a disciplined investment strategy. In the fast-paced world of venture capital, Axel stands out as a testament to the success that can be achieved when planners meet improvisers, when strategy meets opportunity. Chapter 7, titled Benchmark, Softbank, and Everyone Needs 100 Million, dives into the era where venture capital began to reshape the global landscape of innovation, led by figures like Masayoshi Son of Softbank. This chapter is a stark portrayal of the seismic shifts in valuation strategies and funding approaches that have influenced Silicon Valley and beyond. Masayoshi Son emerged as a pivotal figure known for his rapid decision-making and for committing fast sums to startups under the mantra that everyone needs 100 million. This approach significantly inflated valuations in the venture capital space, marking a departure from the cautious, value-driven investments of the past. Son's focus was on market presence and growth, often prioritizing scale over the immediate monetization of innovative products. The chapter juxtaposes Son's strategy with the traditional venture capital model, epitomized by firms like Benchmark. Benchmark represented a meticulous founder-focused approach, emphasizing strategic partnership. Benchmark represented a meticulous founder-focused approach, emphasizing strategic partnerships and deliberate growth. The narrative of eBay and its exponential growth with substantial marketing investment exemplifies the potential of network effects, a concept that Benchmark capitalized on, leading to a staggering return on investment. Yet, as venture capital flooded into Silicon Valley, sparked by successes like Netscape and UUNet, the landscape began to shift. Son's willingness to bet big and fast encouraged a new wave of startups to prioritize market capture over technological innovation, leading to an ecosystem where the sheer size of funding rounds became a marker of potential success. This chapter isn't just about the numbers. It's a reflection on the changing dynamics of venture capital, where the likes of Masayoshi Son have challenged the traditional paradigms. It's a narrative that questions the balance between nurturing innovation and fueling a race for valuation, between the strategic foresight of Benchmark and the bold gambits of Softbank. As we ponder the lessons from Benchmark, Softbank, and Everyone Needs 100 Million, let's consider the broader implications of these venture capital strategies on the ecosystem of innovation. It's a reminder of the delicate dance between funding and focus, on one hand, and between valuation and value creation, on the other hand, that defines the venture capital landscape. Chapter 8, Money for Google, kind of for nothing, takes us through a pivotal moment in the late 1990s, a time when the internet was cluttered with search engines, and the idea of launching yet another seemed redundant, if not outright stupid. Yet, amidst this crowded space, Google emerged, not just as another player, but as a game changer that would redefine the way we use the internet. The decision to invest in Google by venture capitalists like Kleiner Perkins was not just a leap of faith, but a calculated bet on the future. The rationale behind backing a Me Too product in an already saturated market was rooted in a belief in technological advancement and the potential for a latecomer with a superior algorithm to disrupt the status quo. Vinod Khoslas's perspective that if current search technology was only a fraction as good as it could be, Google's superior approach could make it exponentially better, captured the essence of this bet. Google's founders, Larry Page and Serge Brin, had developed a search engine that not only promised better results, but was built on a foundation that valued user experience above all. Their algorithm, inspired by academic citation metrics, was a stark contrast to the brute force advertising and marketing strategies employed by other .com ventures. This nuanced approach, focusing on building an audience before aggressively pursuing monetization, set Google apart. The angel investors who first backed Google, like Andy Bechtolsheim and Jeff Bezos, saw beyond the immediate challenge of entering a full space. They recognized the transformative potential of Google's technology and the vision of its founders. This early support, coupled with strategic venture capital investment, provided Google not just with the funds, but with the credibility and network to scale rapidly. The narrative of Google's funding is a testament to the core principle of venture capital: investing in people and potential, not just products. As Google evolved, defying skeptics and becoming synonymous with the internet itself, it underscored the importance of vision, innovation, and the audacity to dream big, even in a seemingly crowded market. Let Google's story inspire us to look beyond the conventional, to see potential where others see saturation, and to remember that true innovation often lies not in creating something entirely new, but in fundamentally improving what already exists. Chapter 9, Peter Thiel, Y-Combinator, and the Values Youth Revolt marks a pivotal shift in the venture capital landscape, spotlighting the transformative approach of Y-Combinator that redefined early-stage investing. Founded by Paul Graham and Jessica Livingston, Y-Combinator introduced a novel concept: teach the basics of entrepreneurship and provide budding founders with the seed capital to bring their visions to life. The inception of Y-Combinator in 2005 was not just the birth of a new venture firm, it was the dawn of a new era in startup investing. By focusing on batch processing and creating a supportive community amongst startups, Y-Combinator optimized the early-stage investment model. This approach allowed for an efficient, collective nurturing of startups, contrasting sharply with the traditional, more isolating angel investment methods. Y-Combinator's strategy was simple yet revolutionary. Offer young entrepreneurs a modest sum, initially $6,000, to support them through the summer in lieu of a traditional internship or job. This not only provided financial backing, but also invaluable mentorship and networking opportunities. The exchange, a small equity stake in their companies. This model democratized access to venture capital, making it attainable for even the most nascent ideas to find footing. The brilliance of Y-Combinator's approach lies in its recognition of the untapped potential of youthful entrepreneurs. Paul Graham famously noted, "Young people are just smarter," underscoring the belief in the innovative power of the next generation. These ethos attracted a plethora of ambitious founders reshaping the venture capital industry into a more segmented ecosystem with clear distinctions between seed, early stage, and growth investors. Y-Combinator's impact extends beyond its investment model. It fostered a culture of collaboration and innovation, challenging the conventional wisdom of venture capital and emphasizing the importance of community in the startup ecosystem. As we reflect on the legacy of Y-Combinator, it's clear that its influence on Silicon Valley and the broader tech industry cannot be overstated. It changed the game by betting on the potential of young founders, proving that with the right support, even the smallest ideas can grow into technological titans. Chapter 10, to China and Steer. It unfolds the narrative of China's monumental leap into the tech and venture capital arena with a spotlight on the captivating journey of Jack Ma and Alibaba. And this story isn't just about the growth of a company, it's a tale of vision, perseverance, and the catalytic role of venture capital in bridging dreams with global markets. And this chapter is particularly interesting, I think, for European tech enthusiasts. China in the 80s and 90s was nowhere close to where Europe's tech companies were, especially at the end of the 90s. And in less than 2 decades, the situation flipped completely. China, a former communist state, still with a, what we call from the Western world, dictatorship, just outplayed, let's call it this way, outplayed the Europe venture capital landscape. And this book in chapter 10 explains exactly how they did it. Gary Rischel, with his global perspective on seasoned experience in the booming markets of Japan and Silicon Valley, recognized the untapped potential of China's tech scene. Alongside Shirley Lin, whose bicultural and bilingual prowess positioned her uniquely as a conduit between East and West, they foresaw China's impending tech renaissance. At the heart of this chapter is Jack Ma. I think everybody knows him, a figure of relentless dedication and unyielding commitment to his vision for Alibaba. Unlike many entrepreneurs who pivot at the behest of investors, Ma did the opposite. He stood firm, a testament to his belief in Alibaba's mission. His conviction wasn't just in the business plan, but in assembling a team capable of realizing his ambitious goals. His pursuit of John Woo from Yahoo exemplifies this, offering not just a lucrative option package, but the freedom to innovate from California, not China, underscoring the global nature of Alibaba's aspirations. Rischel's decision to leave Shanghai in 2016 marked the end of an era and the beginning of a new chapter for China's venture industry. His departure underscored a pivotal shift. The landscape had evolved to a point where the insights and contributions of an American outsider had reached a natural conclusion, giving way to a self-sustaining ecosystem powered by local talent and global aspirations. And it was the end of the 90s, and in 2016, one of the leading figures in the Chinese venture capital landscape, who came from the United States, left because there was nothing more to do and they could thrive on their own. The journey of Alibaba in this chapter, from its inception to becoming a global powerhouse, is a narrative rich with lessons on the transformative power of venture capital. It's a story that celebrates the fusion of visionary entrepreneurship with strategic investment, highlighting the role venture capital plays in scaling local innovations onto the global stage. Reflecting on Alibaba's ascent and the broader ascent of China's tech landscape, it's clear that venture capital is more than just funding. It's a bridge between visionary ideas and the realization across cultures, borders, and beyond. So we're coming closer to now, and in chapter 11, we dive into the story of Axel's bet on Facebook, a decision that underscores the venture capital firm's embrace of the prepared mind philosophy. This wasn't just a gamble on another social networking site. It was a strategic move grounded in foresight, patience, and a willingness to engage with unconventional innovators. Axel's journey to Facebook began at a critical juncture as the tech bust loomed large and the venture capital industry was riddled with uncertainty. Kevin F. Roos's arrival at Accel heralded a new era of strategic investments driven by a collective resolve to not miss the next big wave in the internet's evolution. Their prepared mind exercise in Sausalito wasn't just about introspection. It was a commitment to identifying and seizing opportunities in the field of social networking. The meeting with Mark Zuckerberg, depicted in shorts and flip-flops, could easily have been dismissed by a less insightful firm. Yet, Axel saw beyond the unconventional demeanor to the groundbreaking potential of Facebook. Mark Zuckerberg's business card back in the days had just a line, and it was, I'm the CEO of Facebook, bitch. And it's also described in the book by Sebastian Mallaby. And when you compare it to other startups pitching, yeah. Afruz's insight that an unorthodox character like Zuckerberg was not just a possibility, but rather the expectation of transformative success exemplified Axel's readiness to invest in world-changing ideas, regardless of their unconventional origins. Axel's decision to invest in Facebook, despite the prevailing youth revolt and the founders' apparent indifference to traditional venture capital etiquette, showcased a profound understanding of the landscape's evolution. This wasn't just about finding a startup with a defendable market position. It was about recognizing the extraordinary impact of a platform that could redefine human connectivity. When Facebook's IPO turned Axel's investment into a windfall of over $12 billion, it was a testament not only to the firm's strategic acumen, but also to its adaptability and foresight. This monumental success story wasn't just about financial gain. It was a validation of Axel's belief in backing not just businesses, but visionaries capable of reshaping the world. Chapter 11 of our journey through the power law is a chapter on venture capital. It's a narrative about vision, about the courage to believe in the improbable, and about the wisdom of embracing complexity. It's a reminder that in the world of venture capital, the greatest rewards often come from the willingness to venture into the unknown, armed with nothing but a prepared mind and an unwavering belief in the transformative power of technology. Chapter 12, A Russian, a Tiger, and the Rise of Growth Equity. In the transformative landscape of technology investment, Chapter 12 of the Power Law shines a spotlight on a pivotal concept reshaping the venture capital world: the growth of incremental margins, a principle adeptly leveraged by Scott Schleifer and the team of Tiger Global. This approach, emphasizing the latent profitability within rapid revenue growth, marks a departure from traditional metrics, focusing instead on how additional income translates directly into bottom-line profits. Schleifer's insight into incremental margins wasn't just about recognizing potential, it was about predicting the future profitability of companies poised on the brink of exponential growth. This wasn't merely financial acumen, it was a profound understanding of the tech industry's dynamics, where costs don't necessarily scale with revenue, allowing for explosive profit growth as companies expand. This principle has since become a beacon for growth equity investors, guiding them towards ventures where growth doesn't just promise scale, but significant profitability. And it was within this evolving narrative of investment strategy that Andreessen Horowitz carved its niche, reshaping the venture capital ecosystem with a focus that was both revolutionary and refreshingly pragmatic. Mark Andreessen and Ben Horowitz, leveraging their unparalleled experience as entrepreneurs, introduced a venture firm that was by entrepreneurs for entrepreneurs. Their approach was not only about financial investment, it was about mentorship, about providing the technical founders with the wisdom, experience, networks, and resources to navigate the treacherous waters of startup growth. Central to Andreessen Horowitz's philosophy was the belief in the transformative power of technical founders, a conviction that these visionaries, when supported correctly, could lead their companies to redefine entire industries. This belief wasn't unfounded. It was rooted in the understanding that in the world of tech startups, it's often the founders who possess the original vision, the deep technical insight, and the relentless drive that are crucial for breakthrough success. Andreessen Horowitz's role then was to amplify this potential, guiding founders through growth challenges without diluting their visionary focus. The development of Andreessen Horowitz, with its unique blend of founder-focused investment and hands-on mentorship, alongside the strategic embrace of incremental margins by investors like Schleifer, represents a pivotal chapter in the story of venture capital. It's a narrative of innovation, of a relentless quest to find and fuel the companies that aren't just growing, but are fundamentally reshaping our digital world. Closing on chapter 12, we are reminded that the journey of venture capital is ever evolving, driven by visionaries who see beyond the horizon. It's a journey not just of investment, but of transformation, where the principles of incremental margins and the empowerment of technical founders converge to herald the dawn of new possibilities. Stay tuned as we continue to explore these groundbreaking shifts in the power law. Chapter 13 of the power law is all about another legendary fund from Silicon Valley, Sequoia. In chapter 13 of the power law, we explore Sequoia Capital's unparalleled influence on venture capital. This legendary firm has not just participated in the tech boom, it has orchestrated it, embodying the essence of strategic investing in Silicon Valley and beyond. Sequoia's unique approach hinges on a blend of ferocious discipline and unyielding commitment to excellence. Doug Leone and Michael Moritz, leaders with contrasting backgrounds, shared a unified vision: the relentless pursuit of success through a meticulous, almost spiritual dedication to their work. Sequoia Capital's secret sauce lies not just in selecting the right startups, but in immersing itself deeply within these companies. The firm's philosophy of strength in numbers sees it engaging in gang tackles, where multiple partners contribute to the success of investments, from talent scouting to global strategy advising. WhatsApp's success story is a testament to Sequoia's collaborative approach, leveraging its vast network to quintuple the engineering team and guide the company towards monumental success. Moreover, Sequoia has been on the forefront of evolving investment strategies, from its Scout program, which turns top entrepreneurs into allies and lead generators, to its company design program, offering courses by the firm's partners to nurture startup growth. Amidst the digital transformation accelerated by the 2020 pandemic, Sequoia launched Ampersand, an app to foster community and exchange among its portfolio companies. Sequoia's ability to pivot and persevere through market downturns, its strategic growth fund initiatives, and its exceptional talent in hedge fund management underscores its ability and foresight. The firm's success in leveraging technology trends, as evidenced by its early investments in digital platform giants and cloud communication companies, showcases its unmatched expertise in identifying and capitalizing on technological disruptions. Concluding this chapter, I can say that Sequoia Capital stands as a beacon of visionary investing, embodying the power law through its disciplined approach, innovative strategies, and an unyielding belief in the transformative potential of technology startups. As Silicon Valley braces for future challenges, Sequoia's legacy and strategies continue to inspire and shape the venture capital landscape. This narrative captures Sequoia's capital profound impact on venture capital, highlighting its disciplined approach, innovative investment strategies, and the firm's pivotal role in shaping the success stories of the tech industry. Chapter 14 of The Power Law delves into the highs and lows of venture capital during the recent tech bubble, spotlighting the risks when investors chase better without bringing alpha to the table. This narrative is poignantly illustrated through the tales of Theranos and WeWork, two unicorns that famously failed to live up to their promises. And it's refreshing at the end of the book to also read stories of failure and not only the success stories. Theranos stands as a stark warning, a company that bypassed the seasoned venture capitalists of Sand Hill Road for a roster of billionaire family offices and individual investors. These venture tourists were captivated by Elizabeth Holmes' charm and vision, but honestly speaking, Sebastian Mallaby describes that they lacked the diligence to scrutinize the underlying technology. The outcome? A resounding failure, underscoring the critical role of professional venture scrutiny. WeWork's journey under the spellbinding vision of Adam Neumann further exemplifies the bubble's success. Initially embraced by venture capital stalwarts like Benchmark for its capitalist kibbutz allure, WeWork eventually became a cautionary tale of overvaluation, fueled by the boundless optimism of Masayoshi Son's Vision Fund. The episode demonstrates the perils of succumbing to the hype without rigorous evaluation. And yet, amidst these tales of caution, we find the principle of focusing on incremental margins as championed by Scott Schleifer at Tiger Global. This approach, emphasizing growth in profits over mere revenue expansion, offers a template for discerning investment, highlighting the importance of deep financial analysis in identifying truly transformative opportunities. And then also there is the story of Andreessen Horowitz, a firm that redefined venture investing by emphasizing the value of deep operational support for founders. Their philosophy contrasts sharply with the hands-off approach of others, like Peter Thiel, focusing on nurturing startups with a blend of strategic advice and practical support, thus contributing genuine alpha to their portfolio companies. Chapter 14 brings to light the dual nature of venture capital, its unparalleled potential to fuel innovation, and its susceptibility to the whims of market sentiment. It serves as a reminder that true value in venture investing comes not from riding the waves of popularity, but from diligent analysis, strategic support, and a steadfast commitment to the fundamentals of business growth. This reflection on Chapter 14 draws lessons from the successes and failures within the venture capital ecosystem, emphasizing the critical importance of substantive contributions from investors beyond mere financial backing to navigate the volatile terrain of tech entrepreneurship. And here we are, last chapter. In the concluding chapter of The Power Law, Sebastian Mallaby offers a profound reflection on the venture capital industry, challenging the notion that success in this realm is merely a product of luck. Mallaby presents a compelling argument that skill, innovation, and strategic foresight play pivotal roles in shaping the fortunes of venture capitalists and the startups they champion. Venture capital, Mallaby posits, is not a game of chance, but a meticulous craft that combines the art of identifying potential with the science of nurturing it. He highlights the stories of firms like Kleiner Perkins, Tiger Global, and Y-Combinator, whose breakthrough approaches to investing have rewritten the rules of the game, underscoring that their successes are not flukes, but the results of deliberate, innovative strategies. Mallaby also delves into the indispensable role of venture capital in guiding portfolio companies through their precarious early stages. From Don Valentine's pivotal interventions at Atari and Cisco to Ben Horowitz's hands-on mentorship of Nikira and Okta, the narrative celebrates VCs as unsung heroes whose contributions often go beyond capital to include strategic guidance, operational support, and invaluable mentorship. Yet the journey of venture capital is not without its pitfalls. The failures of Theranos and WeWork serve as cautionary tales, reminding us that the allure of rapid scale and market domination must be tempered with diligence, ethical considerations, and a commitment to sustainable growth. Mallaby urges the venture capital community to embrace humility, acknowledging that while the path to success is fraught with uncertainty, the pursuit of innovation through skilled investment can catalyze transformational change. In his conclusion, Mallaby not only defends the venture capital industry from its critics, but also acknowledges its challenges, including the need for greater diversity and ethical stewardship. As venture capital continues to evolve, its impact on shaping the future of technology, society, and the global economy remains undeniable. This chapter, and indeed the entire book, serves as a testament to the power of venture capital, not just as a financial mechanism, but as a force that drives the engine of innovation, pushing the boundaries of what's possible, and in doing so, shaping our world. I loved reading this book from the first to the last page, and I think since I bought it 2 years ago, I have read it 5 or 6 times. It's really valuable what Sebastian Mallaby has put together here. From my personal experience in a journey spanning over 3 decades from student societies to the forefront of the life sciences industry, my path has been anything but ordinary. My early fascination with business simulations evolved into a profound engagement with real-world ventures, from European Union-funded research projects with universities like Harvard, St. Gallen, and Uni Graz, to leading roles in life science companies. This diverse experience prepared me for the enigmatic world of venture capital, a realm I entered through a spin-out from Novartis led by Rutger Novak, later the founder of CRISPR Therapeutics. For me, venture capital first appeared as a mystery in 2006. The notions of no revenues, burning capital at light speed, and negative equity were foreign to my corporate conditioned understanding. Through the interactions with leading fund managers invested in Napriva, the Novartis spinout, like Nomura Phase 4 Ventures, HBM Partners, Wellcome Trust, Biomed Partners, GLS Ventures, and Novartis Venture Fund, I began to grasp the essence of venture capital. The pursuit of exponential returns through investments in groundbreaking teams with groundbreaking potential and the next generation of technology. Sebastian Mallaby's The Power Law offered me a panoramic view of the venture capital landscape, tracing its evolution from the last century to the present. Mallaby delves deep into the mechanics of venture capital, elucidating the strategies that have shaped its success stories. From the pioneering days to contemporary titans like Andreessen Horowitz and Sequoia Capital, Mallaby captures the essence of what makes venture capital a critical driver of innovation. Reflecting on my journey and the insights gained from The Power Law, I see the book not just as a historical account, but as a beacon for future founders and investors navigating the venture capital ecosystem. It underscores the criticality of embracing risk, championing visionary entrepreneurs, and the transformative power of investments that defy conventional wisdom. For anyone poised at the intersection of innovation and investment, the Power Law is an indispensable guide. It not only charts the course of venture capital's past, but also lights the way for its future, encouraging a new generation to embrace the challenge of turning visionary ideas into reality. My personal journey, intertwined with the lessons I learned from the Power Law, reaffirms my belief in the transformative potential of venture capital. It's a testament to the indomitable spirit of entrepreneurship and the unwavering pursuit of breakthroughs that have the power to reshape our world. If the journey in this episode through the high-stakes world of venture capital, as chronicled in The Power Law by Sebastian Mallaby, has piqued your interest, I highly encourage you to dive deeper into this fascinating realm. For those eager to explore the intricate dance of risk, innovation, and the unyielding pursuit of disruptive breakthroughs, this book is an invaluable resource. You can find it on Amazon, and purchasing through the link in the description to this episode supports the podcast and allows me to bring more insightful content your way. The wealth of knowledge within these pages is an investment in itself. So, as we wrap up today's episode, I'd like to extend my heartfelt thanks for joining me on this exploration of the Power Law. We've journeyed through the evolution of venture capital from its nascent stages to the powerhouse it is today, guided by the astute observations of Sebastian Mallaby. This episode is just the beginning. In the pipeline, we have exclusive interviews with some of Europe's leading venture capitalists, such as Dan Boyer or Hampus Jacobson, and from across the pond, insights from US investors like Owen Reynolds, Sequoia Servants, and Dan Breezy. They are all set for release in February-March. These episodes promise to deepen our understanding of the global venture capital landscape. Additionally, if you haven't already, I invite you to listen to our previous episode featuring David Dana. His expertise sheds light on Europe's venture capital landscape from the perspective of the European Investment Fund, offering a unique glance into the mechanisms that fuel innovation across the continent. Thank you once again for your time and curiosity. The world of venture capital is vast and ever-changing, and together we will continue to uncover its mysteries and opportunities. Until next time, keep innovating, keep investing, and keep pushing boundaries of what's possible.